I wanted to do favors which gave back to nature. So I kind of had like just over £1,000 to spend on nature, and it was quite an interesting exercise because I think it's what a lot of people do with their carbon budgets, their like nature budgets. So I ended up spending half of it on biodiversity credits, which is the
Mm,
ones we've just launched on our platform, which is protecting the Amazon. And then the other 500 we're using to plant trees. And then again, when you look into planting trees, it's £5 a tree in Scotland. It's 60p a tree globally through one of our clients. And it's yeah, we ended up buying like 1,500 seeds to
mm,
try and grow trees over the next 3 years to then plant in Norfolk. But yeah, it was a really interesting exercise to say, how do I maximize impact?
yeah.
And if you're not having to worry about the measurement of that impact, you can be more impactful. And I think
Mm,
carbon markets obviously have this challenge to say, how do we be impactful and ensure that money's going to the projects which almost deserve it the most? And keep our costs down. And I think as a company, we've tried really hard to keep our costs extremely low. We haven't had these like huge funding rounds, but a lot of money is getting pumped into the services part of the carbon industry. And I think trying to ensure that we use that money to build systems, infrastructure that make the market more efficient and reduce the cost of creating a certificated ton and getting it to a buyer,
mm.
I think is one of the key challenges over the next few years.
And how long ago was that? Because I saw you,
So I came into carbon like 4 years ago.
mm,
Um,
but
yeah,
you came
just about,
from like commodities in like LNG, right? Or
yeah. So I brokered liquefied natural gas for over a decade. So I joined that market when it was in its infancy. It didn't have hedging instruments and was
mm,
quite instrumental in building the financial market for LNG as well as broking the physical and making it look more like a commodity.
mm. Oh, I want to talk about that then, because maybe that just sparks like, so you saw the evolution of LNG markets, right? And obviously LNG provides a really amazing utility for the world, energy, we could see it, we could smell it, we can use it. Whereas carbon's still in its infancy, colorless, odorless gas, not so easy for people to understand the utility. So,
So LNG kind of is because it's liquefied gas, but as a gas, it's obviously colorless. You can't touch it, and
well, as
they
a
often
gas, but
try
as
and
a
say it's
fuel, like, we drill it from the,
yeah. They
um,
say it's when I started, people were arguing it wasn't a commodity and it was just a flexible pipeline because LNG is liquefied gas. You freeze it minus 161 degrees, so you're cooling it to turn it from a gaseous state into a liquid state. So it's 1/600th of the size, and you can then transport it via
mm,
ships. And the ships are effectively thermos flasks, which keep it cold, so you can transport it and move it around. And so it's also not seen as a perfect commodity where it's homogeneous. It's like
mm,
every single cargo is a different source, different size, different quality, um, has different terms around it. So somebody might allow you to divert a cargo, say, in and around Europe. Somebody else might sell it on a fixed destination basis. So there's also differences in the contractual terms on which you trade. So you're trading not just the commodity, you're also negotiating all the terms of that trade. So carbon's actually, in general, it's much simpler. So term
mm,
offtake agreements, you start getting into that realm of trying to balance and move risk around in terms of, does the project developer take the risk of delivery or will the buyer take that risk or who takes the volume risk? will the buyer take all the carbon credits that are generated, or is it only going to take a fixed amount each year? Is it going to take 100,000 tons each year for the lifespan of the contract? So
Mm.
there are a lot of similarities. An LNG project will typically try and sign up at least 80% of its supply, it used to be 100, to long-term off-takers before it builds the facility on the supply side. So it would be like for a carbon project to say it will not reach financial investment decision, it won't go ahead unless it has a long-term off-taker,
Hmm.
which is how the LNG industry have approached it. Whereas in carbon, because it's a much lower entry cost, you have a lot of speculative money coming in to the market.
Hmm.
People are putting money in quite philanthropically, but then
Hmm.
like if we get some carbon at the end of it, great. And then you've got a new wave of investors coming in who are treating it more like a commodity and saying, we need a return on this investment. We need to get some of the hurdle rates are really high. Some people are looking for 60% plus IRR because of all the risks involved. Other
Hmm.
people are saying we only need 20% because they're seeing it as more of a social enterprise rather than a pure, monetary driven one. But they
Yeah.
still need to get a return on their investment. And
Yeah.
I think the fluctuations in the market over the last 4 years, it's very much feeling like what's in fashion. And yes, there's this movement towards quality and a lot of talk of high integrity, but at the same time, there's a lot of people buying the cheapest credits still. So it's quite a polarized market, is probably the trend that we've seen where people are saying we want 10% mangroves or 10% what we call charismatic credits, where they
Hmm.
come with nice marketing materials, lots of sustainable development goals, and then they pad out the rest with, say, the best credits that they can afford with what's left of their budget after they've procured those, yeah, charismatic credits that they want to use for their marketing materials. Um,
Mm.
so yeah, there's a lot of things about carbon where it's not really a commodity because in a commodity, you tend to want the cheapest to deliver. And I know we're going to move on to, but Article 6 and Corsair and
Mm.
compliance markets, you start looking at the cheapest compliant credit, which is, yeah, a big shift, I think, in the dynamics
So
of.
then what? Yeah. And what would you say? I mean, the market is most similar to then? If it's not a commodity, what do you think it is? Is it an art market?
Yeah, so I'm stealing this from Andy Ertel, but when I started, he was the head of evolution brokers, and he said carbon is like art. The value's in the eye of the beholder. And I think it's true. What someone's willing to pay for a project is in part linked to cost. And you have this with any immature commodity market. It all starts as a cost plus, because what buyers are generally happy to pay is whatever it costs plus a reasonable margin for whoever and everyone that's in the chain. Um, and then as the market matures, you get supply and demand price dynamics factoring in. So then it might be cost plus, but then if everybody's all going after those same credits, like for the mangroves projects, it can take it from $30 per ton all the way up to $45 per ton because it's in high demand for a particular project. And you see that the market in general is very well supplied. So we typically have 50 or 60 million tons offered on our platform and a tenth of that on the demand side, or even less. Maybe it's 1% on the demand side. But you can still get buyers coming in unable to find what they want because they come along and they say, we want Malaysian removals, or we want Malaysian removals vintage 24 onwards. And people are asking for things that are either sold out or never existed in the first place because they've run their assessment on what they want, not based on the supply in the market. but they've done, say, an academic search or an academic study of what kind of carbon projects they want to support. Um, and there's a lot of conflicting information. There's people saying removals are better than reduction. There's people saying that new vintages are better than old vintages,
Yeah.
whereas logic might tell you otherwise. Logic might say it's better to plant a tree yesterday than it is to try and plant one in 3 years' time. Um, but if someone's there saying, I want to buy carbon credits for the next 5 or 10 years to meet my 2030, 2035 commitments, and I want it to be a recent vintage for each year that I use, then you're almost saying, let's wait to plant trees until 2030 just so someone can get a recent vintage. It doesn't make any sense. I think for the projects which have been long standing, if you can prove that the trees are still there, then when it comes to nature-based solutions, unless there's been a change in the methodology, there isn't a reason to discount so heavily historical vintages.
Hmm.
Renee knows the history of this, and I've heard it on your podcast, so I don't want to go into the history there. But I do think we need to shift the mentality around vintages,
Mm.
and we need to start doing everything we can to encourage the deployment of capital today and structure the market in a way that you don't get this vintage decay. Because people wouldn't invest in oil or cryptos or gold if the value of their investment in that asset eroded over time. And that's the problem we have at carbon at the moment. The longer you hold this stuff, it just diminishes in value unless the entire complex gets pulled up, then it might rise. But the fact that the older vintages either don't have any demand for them or they have to heavily discount to trade um, is a challenge, I think, to scale at the moment.
Mm. Yeah, certainly. And I want to dive into this deeper. And this is going to be a late introduction, but I have to do it because we didn't introduce you yet.
That's all right.
That was a long-winded cold open, but a great one. But welcome back to This Week in Carbon. I'm your host, Eddie Smith, and today we have a fantastic guest, Melissa Lindsay, the founder and CEO of Emstream and Emsurge. Thanks for joining us today. And Melissa, I think it's just to circle back before we start talking about, the markets and what the lack of, you know, the lack of liquidity in such art market like similarity. I wanted to touch on what inspired you to found Emstream and Ensurge, right? Like for listeners unfamiliar with your companies, could you clarify their roles and you know, building on what we just talked about, how did your experience building LNG markets translate into solving challenges in carbon markets and seeing some similarities, some differences that you just discussed?
Sure. So, Emstream's a brokerage company, brokerage slash consulting on things like marketing, procurement. My background was in liquefied natural gas. I spent over a decade as the global head of LNG at Tullett Prebon. I was there from the kind of infancy of the LNG market, took it through to a stage where we were trading the financial markets and derivatives markets for LNG most days. And yeah, physical LNG is now trading multiple times a day, whereas when I started, one cargo a month may be traded. So it's a very different um, liquid market today. And when I looked at the carbon markets 4 years ago, it felt like it hadn't made the same amount of progress that the LNG industry had managed to make in LNG. And um, it was through my own pain points of broking LNG. So originally I was doing it off a BlackBerry and I was just phoning everyone around, asking them what they wanted to buy and sell. And I got to a point where I had over 700 people on my call sheet, and I had a team across London, Madrid, and Singapore. So I wanted a way of being able to see in one place where all the bids and offers were. And I wanted to know what my bid ask spread was. And LNG had gotten to a point where it traded not only on a fixed price anymore, but it traded indexed to many other markets. So it traded indexed to European gas or US gas or oil. And then it started trading also to the JKM, which was an index which is directly linked to the LNG delivered price in Asia, whereas European gas and oil prices were proxies up until LNG had its own benchmark. And it's a bit like carbon at the moment, in that carbon doesn't have a real benchmark that's used in a way that people can hedge. So there's a lot of fixed price trading. Um, so yeah, I launched a platform in LNG. My previous company let me get as far as designing it within them, and then um, they took over a year to get to a point where they were willing to fund it. And in that space of time, I had been looking around and decided that I would like to ring fence the tech. And so they eventually said to me, if you really want to do the tech, you can leave and do it. Because my issue was, if you try and build software in a large company, you're constantly competing for budget with all the other desks. And the LNG desk never made as much money as the gas desk at the time. It's now shifting. Um, or you're competing with the oil desk or real estate or FX. So they let me go away and build the software. I launched in LNG. I remortgaged the house to do it. I also got funding from quite a number of LNG traders and consultants, brokers in the space. And we were about 3 years in. We kind of just about had working tech, and then COVID hit. And with COVID, it was really difficult to engage any IT departments anymore because you're talking about an environment where traders weren't even allowed to have their mobile phone on the trading floor, to one where all of a sudden traders needed to be able to work from home. So IT and internal resources all got tied up in enabling traders to trade from home. So at that point, we kind of gave the platform and LNG out for free rather than continuing to push sales of the platform. And I started looking at carbon because the LNG industry had started looking at what they were calling at the time carbon neutral LNG. It's now more fashionable to say carbon compensated LNG, but effectively it's the same thing. It's suggesting that it's a more pragmatic way to net zero to pair emissions from fossil fuels with carbon credits. And at the time, people were looking to offset the emissions from an entire cargo, which is around 250,000 tons. And I think maybe what the industry needs to do is go on a journey where we're first reducing and compensating for scope 1 and 2 emissions, and then we move towards scope 3 as well, and have it so it's a plan to get to zero over the next, whether it's 1, 2, or 3 decades. And yeah, so I think what we're seeing now, which is quite interesting in LNG and upstream, is because of CBAM, countries are saying if they don't tax the emissions, Europe is, and then Europe gets the money. So if you're there and you're producing, whether it's in Africa or Asia, and you're producing LNG and oil cargoes, which are delivering into Europe or markets like Singapore in Asia, which are starting to look at their own carbon taxes, I think it makes sense for people to start taxing
Mm.
the emissions upstream.
So,
And a lot of
yeah.
those countries, they want to support their own carbon markets. They want to help create demand for project-based carbon in their countries as well.
Mm.
And I think that's a really interesting dynamic. So we're kind of going full circle, and where we paused on LNG 4 years ago to launch in carbon, we're now looking at relaunching in LNG by the end of the year, and we've started building another LNG platform.
Yeah. Well, yeah, thank you for sharing. And I would just want to touch on CBAM for a second. How significant is the carbon border adjustment mechanism that Europe implemented about 2 years ago now, right? How significant is that on trade with international partners for, emissions intensive commodities like oil and gas? Um, and how do you think that's impacting climate policy in these different regions, right? Like it's spurring compliance mechanisms, hybrid schemes with compliance and voluntary. I mean, and
I think
everything
it's
that's
been
going
a
on with
huge
the US
catalyst.
now as well. Do you think, or some countries are obviously unhappy with the CBAM, others are like, no, it's good. We'll start our own carbon tax, like with what you said. Love to hear your thoughts on CBAM.
I think it's certainly been catalytic, and I think when I was studying a long time ago, it was all talk about globalization, and that was the trend the world was on. Whereas I think now it's more moving towards protectionism, and people are looking at what can they do to increase the revenues and support their own countries and their own economies.
National
And
global
yeah,
resilience. Yeah.
um, and so I think there's this huge opportunity that's being created, and obviously governments move inherently slowly. And so, I feel like we're quite lucky because we're coming into the carbon markets something like what 30, 40 years after someone started trying. Um, but we're a long way down the line, and you're starting to now get to a point where a lot of the initiatives which created this inertia over the last few years, so things like, I know you had Chris Leeds on here, so things like the CCPs, um, all the rating agencies coming in, this huge talk around the integrity, and to improve the integrity, the bad projects and um, the issues with the market really got flagged. And so a lot of the attention was put on what was bad about the market. And I think we can move away from that now and start talking about what's good and what needs to happen. Um, and yeah, with governments across Africa and Asia, what we're seeing is that everybody wants their own carbon exchange. What we're trying to do is tell them, you don't all want your own marketplace. It doesn't make sense for every country to have their own marketplace because you're just going to fragment everything. I think to have domestic ETS schemes and your own carbon taxes and in country incentives, that all needs to be country specific, but there needs to be a fungibility of that carbon or of the carbon pricing internationally. And
100%.
we
Yeah.
So what we've kind of offered as a solution, which people really like, our platform has always been aimed at the wholesale market. So because our LNG customers were the big oil companies, companies like BP, Shell, Petronas, and the big trading houses like Vitol, Glencore, were our clients that were coming into carbon, and they wanted to use their credit lines. They wanted to be able to trade large volumes quickly, and there wasn't a way of doing that. And for a lot of the traders, carbon wasn't their primary commodity they were trading. They were mainly trading LNG or something else. And so we built a platform that enabled them to just post buying and selling interest without posting collateral, without tying up inventory, without the need to go via an exchange. Once someone's matched on our platform, and it's hybrid, so brokers help facilitate that. It's not click and trade, but the counterparties get introduced and then they deal direct with each other. And so people get to establish relationships, they get to use their credit lines, which reduces costs. Um, and that then wholesale market can filter down into the many, whether it's regional markets, sectoral based markets, or just somebody's in-house customers. So anyone can take a front-end marketplace to our wholesale trading platform. So you can now cherry pick what offers you want to show, and you can commingle them with your own onto your own marketplace. So we're talking about doing a marketplace for Africa or a consortium of countries in Africa. We're talking about doing one for specific countries where they can then use their back end infrastructure, so they can then use their exchange to settle these trades if they want to. So they can either allow people internationally to buy direct, or they can go via their exchange. The problem is, for companies, a lot of the largest companies that trade this stuff, to onboard a new exchange or a new carbon standard, um, takes 6 months. It can take longer. It can take over a year, some of the onboarding with these companies. So if every country wants its own exchange, it's very difficult for a buyer to then be able to buy from every country. So people need to look at building infrastructure that isn't just what they want, but is what the customers and the counterparties in the market want or can use. Um, so yeah, what we're looking at is creating a front end, and then we're agnostic to that settlement. So we already have done trades where I would say 95% of our stuff that trades is OTC, but we have done trades with CIX, CBL, ACX. Um, we're completely agnostic. It's where people want to. And I think what you're seeing is with Article 6, countries are wanting to build as much of their own infrastructure as possible, and to use some of the infrastructure they've already got. So things like exchanges, but the focus has really been on supply. And there is a lot of wealth in these countries too.
Hmm.
And the governments are realizing we want to boost and help the supply side of the industry that they have been doing, but actually we could go and create demand here as well. And whether or not it's a carbon tax on the most profitable companies or the biggest companies, there's a way of certain industries, but there is a way of generating demand, I think, also within Africa and Asia. And although the original concept of the carbon markets was an acknowledgement that the global north has created much of the damage and the south are the ones which are going to suffer the brunt to it, I would say most people in the south are more pragmatic, and they're not saying, well, you created this mess, so we don't want to help. I think they also want to be part of that decarbonisation
Totally.
journey, um, and look after our planet. And then
Yeah.
certainly the younger generation are much more open and willing and wanting to preserve their planet. It's the older generation which unfortunately are quite often holding the seats of power, which are like, oh, we'll be dead. And, I still meet people that deny the impact of fossil fuels.
Hmm.
And, you know,
Yeah.
I had someone tell me the other day about the Ice Age. I was like, no, I'm pretty sure the scientific community are now 100% behind.
That's actually it's actually it's crazy when you think about it. I mean, I was watching there's actually a new Netflix documentary about like the White House effect in about like the Bush administration, about like climate change policy in the US. And this was in the 1970s, in the 1980s. I mean, this was a known fact over 50 plus years ago. And you know, it's just crazy to see people still arguing about a known fact by physics, right? I mean, you can't really argue with physics. Um, but I really like what you said on the like efficiency and settlement, and like I think you touched on like exchanges, post-trade kind of infrastructure. We're seeing that automate like KYC contracts, settlement processes. How do you help buyers sort like high integrity, high quality credits on your platform?
So we're completely agnostic, and most of our clients are professionals, and they're the intermediaries which are often helping and advising corporates on what is quality. And so, because we don't want to also have a conflict of interest by telling people, this is a good project, you should buy it. We want to remain agnostic, but we do want to steer people towards and give them the tools to help them source high quality. We've got partnerships in place with Calix and Silvera. And so, under those partnerships, our users are able to view um, and select and filter for high rated projects. They have to source directly if they want the deeper dive, but quite often it's enough for someone that they'll say, we want a well rated project. And they don't actually mind which rating agency. So long as one of the rating agencies has given them a good rating, then they'll look at it. Calix also separately rates the Sustainable Development Goals, which we really like. Um, and Silvera have this connect to supply, and with Silvera, with Calix, we do something similar where what we do is we allow people who post the offers onto our wholesale platform. Those offers are then shown, but with a kind of like an like an averaged or a price range that we don't show the exact price on the other platforms, but they're able to see what's available elsewhere. And the idea is so that project developers don't have to manage their inventory and sales on multiple different platforms. If they ended up trading, they can just manage and reduce the volume on our platform, and it will automatically be reflected on not only the rating agency platforms, but it will also be reflected in the marketplaces that are connected to us. So we took investment earlier this year by a company called Quidos who have invested in us in order to have a marketplace specifically for the built environment. So it's in the process of being launched, but that will be carbon credits which are generated from decarbonizing the built environment and in large targeting property developers and people in that space. And we're seeing that's quite common that a sector, it's not so much insetting, but they are interested and drawn to carbon credits which help tell a story or help decarbonize their own sector. Um, so it's like you see the shipping and the freight companies are interested in mangroves credits.
Yeah. Yeah, certainly like supply chain decarbonization is a much more internally greater selling point to a CFO, like something that really correlates to the company's operations and carbon footprint globally. I mean, that's what we're seeing where, at companies aligned with SBTI are really figuring out their scope three supply chain emissions with insetting. But that's great. And I also wanted to touch on some other recent developments um, and touch on Article 6, which I think we talked about briefly before. But you recently partnered with CASE, right? Climate Action Center of Excellence.
Yeah.
Can we talk about that?
Yeah, definitely. It's been one of my favorite partnerships. So Alexandra Souza there, Dr. Alexandra Souza, she's incredible. She spent many years working for the UN, operationalizing Article 6 before joining CASE. CASE is a non-for-profit where they're really there to help countries operationalize Article 6. And having been to the carbon markets event recently in South Africa a couple of weeks ago and earlier this year in Kenya, went to the Kenyan Carbon Markets Forum. Um, there's a real need in Africa. There's a willingness from the governments to embrace carbon markets and to support these projects and to support projects in their country. They just need the help to do it. And I think the rules keep shifting. What people keep saying you need to do, there were some governments from like Ethiopia and Uganda, and then they've been trying to have results-based financing from Red Plus or Red for um yeah, over a decade, maybe well over a decade, maybe coming up to two. Um, and every time they do what they're told to do, when it's on the measurement side of things and putting the reporting in place, It's just another hurdle. And it's like now you're getting to a point where there's been very little climate finance given to these nations, not just in Africa, but around the world, who were promised the rainforest nations who were promised this results-based financing. So now they're turning to Article 6. And you've got some people within the UN who believe that red should sit within Article 5, and it's not really meant to be in Article 6, but it is moving into Article 6, and there are projects which are issuing Article 6 credits, and I think it's very hard to stop that because the climate finance wasn't there. But climate finance and carbon finance are two different things, and climate finance was meant to be used to meet the country's NDC, its nationally determined contribution, so its target. And then over and above that was where carbon financing came in. And you weren't meant to sell or export any carbon until you achieved your NDC. But the problem is, none of these countries are being given enough climate finance to meet their NDCs. So technically, there isn't really going to be any um, Article 6 credits to trade unless the rule book shifts or unless all this climate finance steps in. So
Mm. Yeah, I mean,
I think there's a few
lack of
different
finance.
timelines going on with Article 6,
Yeah.
but I think what is clear is that carbon finance could be a tool to really increase and scale financing for nature and financing to decarbonize and for adaptation. It just needs to be allowed to be used. It feels what's really needed is that people should be allowed to use carbon financing to help meet NDCs in the absence of climate finance. Um, but I think it's a really hard thing to get global agreement on.
Yeah. Well, I mean, hopefully something comes out of COP these
Yeah.
past week, these next few weeks in Brazil. Um, and I completely agree with what you said on Article 6. I mean, it's really interesting to see how these rules are being shaped in real time, right? I mean, I've been following the whole drama, what's going on with permanence and reversals for nature-based projects in Article 6. Do you have any thoughts on that? Have you seen this?
Yeah. I mean, I think I think we just need to move forward. And there's a lot of academic argument, but what we need to just focus on is how do we leverage capital? How do we attract capital? And so people need to put in place the frameworks required to attract capital into the market. And more than anything, that requires certainty. You know, what we just saw. So in the last week, Vera and IKEA rolled back on the exclusion of some project types. So initially they said we're going to exclude certain cook stove projects from Corsia, and they've now rolled back on that and said actually they are now allowed. But a lot of those project developers had already started or had already done a transition from those older Vera methodologies to new ones or all transition all the way onto gold standard, and a massive haircut on the carbon credits was required. And now it's being told that they could actually sell the credits from the old Vera methodology as Corsia. There's a whole wave of other hurdles that these projects then still need to get through to have a Corsia credit. Um, but yeah, things very hard to invest in an industry
The
where the
uncertainty.
goalposts
It's
keep
just,
moving.
yeah.
Yeah. And so you've already seen people shy away from the VCM and say, you know, we've had our fingers burnt there. We only want to invest in compliance. So whether it's South African, Colombian, Singapore, Corsia, but they want to invest in project-based carbon if it can work into a compliance market. Um, and these big shifts, if people are investing in Corsair because they're expecting Corsair price of over 20, and then rules get changed to allow in credits which are worth only $10 and brings the price down, that's not good for anyone either. So, yeah, I think there's quite a lot of people who have had their fingers burnt one way or another um, by moving early into these markets. And now you're it's hard to rebuild that liquidity and to get people to come back in. And I think the airlines are sitting hoping that they'll get an extension because of the lack of the supply, that they'll get an extension on when they need these credits by. Um,
Mm.
so yeah, I think
Yeah, that seems to be a fundamental structural problem for the market. It's just that, it's the not only is it very fragmented with very different, different standards, different, over 30 registries, but it's these rules and keep changing, right? The goalpost keeps changing, which from an investor's perspective, it's like, why would I ever want to allocate any of my capital towards a market that has that much uncertainty when I can put my capital in a market that has complete certainty of earning, 8% risk adjusted return for the year, right? It's it scares away capital.
yeah, because ultimately you're trying to move money from somewhere where someone feels comfortable and it's known. So, they've been investing in coal mines for the last 20 years. So they know they just buy a mine and they mine it and they're very
Mm,
comfortable with that risk, or an oil well, or um there's a lot of people I would say who have maybe come in from land management and property. But from whichever aspect they're coming in, you're having to get them to put in risk capital into a market versus somewhere where they're very comfortable and they've got known, almost guaranteed returns because that's their core business. Um, so yeah,
right.
I think carbon needs to have a very compelling story for people to invest, and term off
Mm,
takers would be great. So getting more long-term buyers to commit. But the problem is because we keep saying, to anyone who did a 20-year offtake agreement, and then all of a sudden you're now saying, no, it should really be Article 6 to be truly additional, to be sure that it was additional and the government wouldn't have done it anyway. It needs to be an Article 6 credit, or it needs to have CCP in order to make this particular claim. And so anyone who was signing long-term offtake agreements 5 or 10 years ago for 20 years, they might now be getting credits that are no longer considered high enough integrity because the market's moved the bar.
mhm. Yeah.
Um, and so because it's been this continual shift, I think you've got buyers who are now sat there saying, we don't want to sign a 10 or 20-year deal in case in 5 or 10 years' time, what we need is something different. Or if their emissions end up falling under a carbon tax, then,
Mm.
oh, we don't need these offsets because we're going to be paying the carbon tax. So,
Yeah, it's a wait and see approach at the moment from a lot of different sectors. But it also, I mean, another the other complexity is that every jurisdiction is so different, right, with these rules and regulations. I mean, we're certainly not going to see a national carbon tax in the U.S. at any point in the near future. Um, so you have these massive Fortune 500 companies just voluntarily, buying and signing long-term offtake agreements. Um, and they don't have to, right? So it's just, I think, but once those buyers stop, like a Microsoft or, the folks in Symbiosis, they're going to stop buying at some point. They're not going to need carbon credits forever. I mean, that's when you need other companies to fill that gap, right? And kind of fill the void once they leave. Because I think Microsoft was probably 90% of CDR purchases this year. right? Like, what happens if they step out of the market?
So everything Microsoft does only helps the primary market. They haven't actually done
Yeah,
much
there's
to
no
help a
secondary.
secondary market.
Yeah.
And the secondary market is what's key to
Well, just,
attract funds and investors and more capital.
yeah, but would you say yes, 100%. But in order to have a liquid secondary, you need the primary to be built up in the right way, which it wasn't before, which is why that crash came down, right, in 2021. Would you
So I
say
think there were two
like
things to the crash. And
well,
that's because
example
buyers
why?
like Microsoft aren't using the secondary market. So if everybody just used the primary market, anyone who takes risk and speculatively buys or invests in projects doesn't have an outlet for their credits. So it needs to be a bit of both. But I think part of the problem was when prices started going up, a lot of people entered the market with remit to get long and they got long. And then you had a period of like 2 years of, people are still selling down their books. Things that they bought in 21 are still sat on books
Hmm.
where people haven't wanted to crystallize the losses or they simply haven't been able to sell those credits at all. Um, but rather than those buyers being in the market for the last 2 years, which is why retirement stayed up.
Hmm.
But there were so many people with so much volume sat in their books that whenever they were dealing with a corporate or a customer, they just sold what they had. They didn't have to come into the market. Whereas now the market feels more balanced and there's more activity because people aren't holding and sitting on these large books. A lot
Hmm.
of people have realized that if I have demand, I can easily go into the market. They can come and use Emsurge
Hmm.
and they've got their choice of like 50, 60 tons. There isn't much
Yeah,
value in holding stuff on your books anymore because it's so easy to access.
yeah.
Um,
It just depends on, you know, it's very project specific, right? And like the different project types, and the specific projects that are liquid that we see, like a Cotingan or like a Delta Blue. It's like uh, the way that I've been seeing the market. When you look at the market in aggregate, like from a standardized, generalized point of view, it's very hard to make generalizations because of how different the market looks in different project types. And I've found that's what I've seen make the market very difficult to standardize. It's just how different, because each project type seems to be a completely different market, right? With completely different stakeholders and completely different impacts on corporate supply chains and different buyers. And, um, you know, so you have
I think
any,
I think the standardization will come through compliance markets like Corsair. So when it
mhm,
comes to Corsair, you're already seeing it. The airlines will want the cheapest compliant Corsair credit. It actually isn't important where it came from. And because the whole quality bar has gone up, you would expect, or you're hoping, people I think will hope that if it's a Corsair approved methodology and if it has that corresponding adjustment by the government and the insurance, because the insurance companies are only insuring what they consider to be robust projects. So airlines can somewhat protect themselves by buying something that meets all that criteria. Um, and so at that point, buying a generic credit off a trading house, one, it can be cheaper. Two, you remove all the project delivery risk. So if you buy from a specific project and you're an airline, you run that risk of that project um, underperforming or the government revoking or it not being put in the BTR. There's risk associated where if you buy from someone who aggregates from multiple projects, so someone who maybe buys from 10, 20 different projects and just guarantees you a credit, a Corsair credit,
Hmm.
Then that intermediary takes the risk. So for me, companies like um, Vitol, BP, Shell, um, they've been doing this across commodity markets for decades. This is what they do. They warehouse risk and they take that risk on for counterparties and they trade around it. And also, I think we could expect to see the ICE Corsia contract, or whether it's the ICE one, I would expect to see a futures Corsia contract eventually take off, and people then can financially risk manage that Corsia price. And because we're already seeing it, people are wanting to sell Corsia credits on an index. So they're wanting to sell the credits at like a percentage of the ICE Corsia level.
Hmm.
Um, and I think that's a step forward. So I think we can expect to see a futures market emerge for Corsia. The reason we haven't seen it on Red Plus or Cookstows or anything else um, was because I think the product was wrong. I think the NGO and the GEO confused or combined a financial hedging tool with a benchmark, with a product corporates or someone might actually want. And the problem was there isn't anyone that wanted a generic um, NGO or GEO delivered credit. People, I think, at the moment in the voluntary space are very specific about which projects they want to buy from. They're extremely specific. It's like um, even an Indian renewable credit that's say A rated or B rated, it's not fungible with another one. The due diligence that people are doing is, down to the implementation of the project, the use of funds, um, who the counterparties involved, what the shareholding looks like of that project. And so there's a lot of things that go into someone's decision on whether or not they buy a carbon credit in the voluntary space.
Hmm.
Um, so to index a project or to create a project to physically deliver, I think is challenging. But there's no reason you couldn't have a pure financially settled futures contract in carbon. So, for example, what we've been looking at doing is having a benchmark, which is an assessment of a very good red project. So it's a hypothetical one. So it could be a lookalike of Kattingen, but it's not Kattingen. But it
Mm.
could have all the same qualities as Kattingen. It just isn't it. So then if there was a bad news story in Kattingen, it wouldn't be impacted. And so it's for people to then assess where is that price and whether it's a price reporting agency that Platts that do it, or we were looking at doing it where people could um, submit their assessment into our platform and then we'll spit out what the average assessment was. But you could take an assessment then of a virtual project and then people could index forward sales to that benchmark, which is an
Mm.
assessment. And then it can't be impacted by news.
Yeah, it almost, I mean, what comes to my head is having a futures contract that's for project types with, let's say double A rated Red Plus or like triple B ARR, like something that kind of holds the, what do you
So I
think?
think, yeah, I think like VCS, ARR, CCB from a least developed country in Africa. You could have something like that where um, somebody more technical than me could have a virtually designed project that you're assessing, and then you just use similar data points. So you could see all the data points and bids and offers for those type of projects and use them to make an assessment on where that virtual project was. But I think the obvious ones to do would be ARR. Um, I think J-Red is going to be big. One,
Mm,
because multiple countries around the world, multiple projects, all of these projects will bring on swaves. You've got large volumes. And where you've got large volumes, people can't say, oh, we only want to sell to an end buyer. That volume is going to trade to traders. So it's going to be like Rimba and Catty, where there'll be a certain, yeah, a relatively healthy churn ratio, I would imagine, on that volume. So there's enough supply. So I think it will come. And then if you can get an index to work in one of those markets, you could take that same methodology and then apply it to something, whether it's cook stoves, Corsair. But I think Corsair will come first and then J-Red because of volumes. The problem with ARR is there's not a huge amount of volume yet. Um,
yeah.
Maybe biochar people will get an index on. But all of this, to get a trusted index, you need transparency. So
Hmm.
our view was, as a starting point, to create transparency in the OTC market, to create a kind of consensus on where prices were. And then you can use that to try and establish a benchmark. So we've been speaking to a few benchmark administrators. I don't want to be a benchmark administrator because I've got the broking business Emstream, and to be setting prices and broking them,
Hmm.
um, you can get in issues where people will say, "Oh, you've set the price there because it suits your best client," or um, yeah, you run into conflicts. But I
Yeah.
think the whole carbon market is conflicted. So
Hmm.
there's a lot of people with their
Certainly see.
fingers in multiple different pies.
Yeah, well, maybe we can get into that on another
Yeah, offline.
episode. But I do like what you said about Corsia. I think you're spot on. But I mean, there are such significant risks on both supply and demand right now with the state of Corsia. I mean, just the volume of credits with LOAs and see corresponding adjustments, like that's just structural supply risk. You have enforcement by major emitters like the US and China, who are responsible for a large share of international aviation emissions, um, have not confirmed if or how they will enforce Corsia, right? So that leaves some kind of regulatory uncertainty. And then you have the EU potentially deeming Corsia ineffective. It may expand the EU ETS to cover long haul flights, um, which would undercut ICAO's framework and further fragment the regulatory environment. And those are just three things that
Yeah, people
there's
have
a
said, the risk that you've got there of the EU and China doing a bilateral agreement where it says, 50% of the emissions get covered by the EU ETS and 50% get covered by China's ETS. And yeah, there's a lot that could happen on the policy side, um,
yeah.
that kills the market. I think a lot of people are hoping that doesn't happen. I think Article 6 will still exist as a market, though. I think as corporates start learning what Article 6 really means, and the fact it means you've got this assurance that that ton is additional and you're almost getting two for one. Technically, you should get at
Mm.
least two for one. But a lot of governments are looking at only giving corresponding adjustments to projects which have a multiplier effect, which help them achieve their broader climate goals. Um, and then obviously, I think the real challenge is for projects which are outside a country's NDC, which don't qualify for Article 6. It's keeping demand for that. But if corporates' understanding of Article 6 improves, I think having a no objection letter and confirmation from the government that they are supportive of that project that sits outside their NDC, and it's allowing a company to come in and develop that credit and use it, and that it's not going to be double counted because it's not included in its inventory or it's not going towards its NDC. um, I think is where we'll move to. And I think what Article 6 will end up doing is hopefully um, bringing together, like consolidating carbon pricing around the world. and because everything should be much more aligned.
Yeah, certainly. And this leads me, I think, to a good, closer and forward-looking question, right? And we touched on Article 6, and we touched on key infrastructure developments, touched on market liquidity. But I mean, would you try to paint us a picture for the carbon market in 2030? Like, what do you envision uh, the market dynamics being like in 2030 versus today? I mean, do you think we have more unified global platforms? Do you think the digitization piece on the blockchain, you know, takes a big role? There's obviously a lot that goes into that, but overall, what's your overarching, you know, optimistic viewpoint?
I think we'll see consolidation across companies at the moment. The market's massively fragmented. The barriers to entry have been really low. Um, and so, yeah, I think there should be a decent amount of M&A activity. I think there's going to be some really good opportunities for people to pick up assets for cheap over the next few years. I think there's going to be a shift towards Corsair, Article 6 compliance markets. I think it does leave a bit of a vacuum for projects which are in sectors outside of someone's NDC. And you already see this with, Kenya's struggling to say, how do we attract investment into projects when they can't just give corresponding adjustments to all projects? Some project types, will sit outside the NDC. So I think that's a challenge that the market be interesting to see how it overcomes. But I think, yeah, we'll have more clarity around that. I think you will see demand from Africa and Asia and other countries that have been typically just considered on the supply side. And hopefully, what they're doing will stimulate Europe to step up. Already, I think the inclusion of potential Article 6 credits in the ETS is a really big one. Um, you already had companies saying that because they've got 2030 targets, 2030 is an interesting one because you've got the lead up to it. So 2030 will be an interesting year in terms of whether or not people stick to their targets, push their targets out, and whether or not there is any kind of, even if it's a social penalty, but whether or not people really care if targets get missed or pushed. Um,
Mhm.
and yeah, I think we'll start to see, greater sophistication on the trading side. I mean, I think it's almost impossible with the pace of technological change that AI is enabling to make predictions. But I think certainly you've had a number of people looking at how do you take data from project inception through to a marketplace. Well, we've had a number of those conversations with people who are saying, you've built the marketplace. So eventually, once you've done our DMRV and the digitalization of the tech stack to generate a credit, to then integrate with our platform. But I think, yeah, within our carbon platform, you'll certainly see the ability to drill down into projects and get much of that and like source truth and data direct. And then those frameworks can be built in terms of assessing the quality of the project based on those continual data inputs that we can stream into our platform. And then the vision that we have is really that our wholesale marketplace, all of these Article 6 projects are listed on the wholesale marketplace. The governments then have the visibility of their Article 6 projects. And as they trade, as they need to make those corresponding adjustments and what prices they're going for, and essentially, because a lot of these governments are getting a share of proceeds back, the revenues they can expect. So that kind of ongoing mark to market valuation of a country's carbon, and yet in a much more interoperable space um, with the data and that transparency around the projects.
Yeah. Well, very well said. And thank you so much for joining me today on this episode of This Week in Carbon. It was a pleasure. And we unpacked a lot of insights and perspectives on the market. So thanks again for joining. And shout out to our audience for tuning in. And
Thanks
we'll
ever so much for having me.
yeah.
Thanks, Tom.